Ladies and gentlemen, good day and welcome to the PVR Inox Limited Q2 FY2024 conference call hosted by Axis Capital Limited. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Ankur Periwal. Thank you, and over to you, sir.
Yeah, thank you, Anju, and good afternoon, everyone, and welcome to PVR Inox Limited's Q2 FY24 post-result earning call. The call will be starting with a brief management discussion on the quarterly performance, followed by an interactive Q&A session. PVR Inox management will be represented by Mr. Ajay Bijli, Managing Director, Mr. Sanjeev Kumar, Executive Director, Mr. Nitin Sood, Group CFO, and other senior management personnel, including Mr. Alok Tandon, Co-CEO, Central, West and East, and Mr. Gautam Datta, Co-CEO, North and South. Over to you, Mr. Bijli, for the initial comments.
Thank you very much. Good afternoon, everyone. I'd like to welcome you all to discuss the unaudited results for the quarter and half year ended September 30th, 2023. I hope you've had the opportunity to review our presentation and results, which are uploaded earlier today on our company's website as well as the stock exchange's website. I'm delighted to share the quarter ended September 30th, 2023 was a record-breaking quarter in company's history with the highest ever admits, ATP and SPH, leading to highest ever quarterly revenue, EBITDA and PAT. In Q2 of FY24, we welcomed 4.8 crore guests and delivered an ATP of 276 and SPH of 136, which represents a year-on-year growth of 64%, 25%, and 15% respectively over pro forma PVR for Inox numbers in Q2 FY23. Coming to the financial results for the quarter, the following numbers are after adjusting for the impact of Ind AS 116 relating accounting. Total revenue for the quarter was 2,020 crores, EBITDA was 447 crores, and PAT was 207 crores. Pro forma financials of PVR and Inox combined for the same period last year were revenue of 1,082 crores, EBITDA of 16 crores, and PAT loss of 78 crores. The biggest highlight of the quarter was the historic performance of the Hindi box office. Jawan and Gadar 2 released during the quarter emerged as two of the biggest grossing Hindi films of all times, recording over 750 crores and 620 crores at the box office respectively. In addition, mid-scale movies like Rocky or Rani Ki Prem Kahani and Oh My God 2 each grossed over 150 crores, while Dream World 2 and Fukrey 3 comfortably exceeded the 100 crore mark. Volatility in Hindi films performance has reduced considerably, with a marked improvement in the average collection of Hindi films, particularly in the case of mid-scale movies, which have been making a strong impact at the box office. Hollywood films helped the quarter start on a fantastic note. Blockbusters like Oppenheimer and Mission Impossible Dead Reckoning Part 1 grossed over 150 crores and 130 crores. Barbie and Nun 2 also performed well and crossed the 50 crores mark at the box office. Regional movies across languages continue to demonstrate stable performance. Jailer, which is Tamil, was the highest grossing regional movie with 390 plus crores of box office collections. Bharatman Hari Deva became the second highest grossing Marathi movie with box office of 90 crores plus. The growing acceptance and attraction of regional content is demonstrated by the success of these movies. We are confident that regional films will continue to do well in the upcoming months. We're quite optimistic about the robust content lineup we have across all languages over the next few months. From Hindi, we have Ganpat and Tejas in October, Tiger 3 in November, and Animal, Sam Bahadur, Merry Christmas, Yodha, Donkey and Salar in December. From Hollywood, we have Killers of the Flower Moon in October, The Marvels, Taylor Swift's the Thor movie, Napoleon in November, Wonka, and Aquaman and the Lost Kingdom in December. From the regional genre, we have Leo, Moja Hi Moja, and Tiger Nageswara Rao in October, Nal 2 in Japan in November, Captain Miller and Hi Nana in December. In the first half of FY24, we have also reduced our net debt by 328 crores. This firmly places us on the path to attain a free cash flow positive status by the end of FY24. On the integration front of PVR and Inox, it is progressing seamlessly and is yielding substantial operational efficiencies as outlined in our investor presentation. PVR Inox continues its strong growth momentum, adding 68 new screens in the first half of this fiscal, while strategically exiting 33 underperforming screens. We are on course to open 150 to 160 new screens in FY24 and expect to exit a total of 60 screens in the current fiscal. Our screen portfolio stands at 1,702 screens across 358 cinemas in 115 cities in India and Sri Lanka. I now open the platform for any Q&A. Thanks once again.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Abhish Roy from Nuvama Institutional Equities. Please go ahead.
Yeah, thanks for the opportunity and congrats on a very good set of numbers. My first question is on your debt levels coming down by 327 crores. I wanted to understand, given now you are much more confident from the Hindi movie business, which was suffering for the industry, what will be the plan from a 1 to 2 years perspective on the overall debt levels? You had rationalized the store openings, the cinema screen openings also earlier. Would that change because of now free cash flow turning on the favorable side?
You're saying that will our opening of screens get impacted?
Yes.
No, because we still have a pipeline, as I said, of 100 to 150 odd screens that we will be opening. And I think the accruals will be enough to take care of both. And every screen that we are opening is going to be value accretive. We are obviously very conscious of now how to invest capital, where to invest capital, which mall, which development, which catchment, maybe in South India as well. And keeping everything in mind, we should be able to maintain our growth trajectory as well as pay down.
So, just to understand, 1,100 crore net debt which is there currently, what will be the long-term goal on this? Do you have any aim to make it almost negligible over the next 2 years? Will that be your vision?
I'll let Nitin answer this question. Nitin, would you like to answer it, please?
Yeah. So, Abhish, you're right. I think as you've seen, so I think reduction in net debt will not come at the cost of growth. Our operating earnings and cash flows will continue to grow, and they'll be sufficient to take care of our growth. And the surpluses will be, used to reduce the net debt levels in the balance sheet. Our focus this year, obviously is to get down to a 1:1 net debt to EBITDA. But over the next couple of years, reduce that from existing levels.
Sure. My second question was on your promotions in F&B. So essentially this 99 rupee Monday to Thursday kind of pricing which you have introduced, I think it's a great initiative. And on the other hand, you have this unlimited refill offer for the weekend. So how is the response here, especially in the Monday to Thursday kind of a lean period when footfalls are low? But within those footfalls, are you seeing a much stronger conversion than earlier? So some insights into that?
So largely 99 rupee promotion was done to correct the price perception of cinema food being expensive. Number 2, we wanted to drive higher conversion at the concession. Both the objectives were completely met, and this is something that we plan to keep the promotions on for a long time. We are not going to sort of get off the promotion. So this is something which is going to be there because we realize that consumers today are looking at movie experience which is bundled in with F&B. Everyone who gets to the cinema would ideally want to eat. So from that perspective, a great successful program is there, and we are trending well on both the parameters.
Sure. And last quick question on advertising revenue, quarter on quarter, very good scale up. And now that you are quite confident on the movie industry revival, which I think will be also true for the advertisers, and overall GDP is doing also quite well. So in that context, where do you see pre-COVID level getting breached in the outlook, from an outlook perspective? When do you see pre-COVID level on advertising getting breached?
That will be next year. Largely, we will come within the hitting range this year. Quarter 3 and quarter 4 are looking very good and positive. But in terms of reaching the pre-COVID PVR INOX combined revenue, it will be next year. We will go ahead of that number next year.
Okay, understood. Thanks a lot, sir. That's all from my side.
Thank you so much. The next question is from the line of Harit Kapoor from Investec. Please go ahead.
Yeah, hi, good evening. I had a question on the synergy bit. You mentioned in your release that the number is already 120 to 140 crores for the first half. So if you could just give us a guidance of whether this year will be able to...
Hello, Mr. Kapoor.
Yes.
I'm sorry to interrupt you, sir, but your voice is echoing. Can you please come to a place where you could get a good reception?
Sure. Is this better?
Hello.
I'll just reconnect that.
Yes, you can connect. The next question is from the line of Mr. Jignesh Joshi from Prabhudas Lilladher Private Limited. Please go ahead.
Thanks for the opportunity. I was just trying to think through how the footfall count will be maintained for the subscription plan that we have just launched. Basically, the customer here is paying us a fixed fee to buy the subscription. So, irrespective of how many times he visits us, basically we have our money. So, will every visit be considered as a separate count, or how will it be basically?
Please repeat your question because there was a lot of echo. We couldn't sort of understand.
Oh, okay. Is this better now, or is it echoing?
It's much better.
Yeah. So I was just trying to think through how will the footfall count be maintained for the subscription plan that we have just launched. So if I understand this right, the customer here is paying us a fixed fee to buy the subscription, so to say. And irrespective of how many times he visits us, we have got our money upfront. So how will the footfall count be actually be maintained? Will every visit be considered as a separate footfall, or how will it be?
See, this is like a subscription voucher which is being sold to a customer. Every time he comes to the cinema, a ticket will get issued to him, and that is how the subscription count will be captured.
And this 699 is largely an advance that the company we are holding.
Got that. And how will the revenue recognition happen? Will it be on the sale of the pass, or will it be amortized over the term of the plan?
Sorry, I did not understand your question again.
The revenue recognition, how will it happen? Because this is a minimum 3-month plan, if I'm not mistaken. So will we recognize the revenue right at the sale of the pass itself, or will it be amortized over the term of the plan?
Yeah, so it's not a long-term pass, it's a monthly pass, so it will be recognized at the end of every month.
It has a validity of 30 days. So 699 expires within 30 days, and within the 30 days you get 10 movie vouchers. So if you do not sort of end up using those 10 vouchers, there is an expiry and then you move into the next month.
Got that. One last question from my side. If I look at our screen portfolio down south, I think the screen mix for us is about 32%. But if I look at our box office share in the Jailers collection, I think it is a bit low at about 17% odd. So is there any specific reason to look into it? Because our screen concentration down south is pretty decent, but our share in Jailer is a bit low if I compare it with our screen mix.
No, so that's an incorrect comparison. South is a very large market which comprises of Karnataka, Kerala, Telangana, Andhra and Tamil Nadu. Tamil Nadu is a subset of South India. Jailer as a film is a Tamil film which was primarily released in Tamil Nadu and did exceedingly well in Tamil Nadu. So you have to look at it in that context. And while we have about more than 500 screens in South India, the total screen count in South India, if you include single screen cinemas as well, is in excess of 4,000 screens. So obviously our market share in South India is much lower, and that's the reason we've been mentioning in all our calls and conversations. As more retail development happens in that part of the market, we want to add more and more multiplex screens because we think that part of the market is under-screened in terms of multiplex screen capacity.
Got that. Thank you so much and all the best.
Thank you. The next question is from the line of Arun Prasad from Avendus Spark. Please go ahead, sir.
Thank you. Thanks for the opportunity. My first question is on the advertisement revenue. I think on a per screen basis, we are still at least 30-40% lower than the pre-COVID levels. And I think this is the best quarter we had, even better than the June 22 quarter, almost double the revenue. Footfalls are also much higher. But obviously on a per screen basis, the growth is very less. Is it a structural issue that advertisers are not coming into the cinema? Because this is something which is happening for the last 3-4 quarters. Despite all the strong footfalls, we are not translating into the advertising revenue on a per screen basis.
Advertising technically works on big blockbuster films doing well. We've spoken about this in our earlier calls as well, and we were very positive that Q2 would have some big titles and on basis which advertising will go up, which is exactly what has happened. Even now, as we move forward, advertisers are coming back. There is absolutely no issues there. It's just that we need a certain momentum to be able to get the monies which advertisers earlier used to plow back into cinemas, which had gone into other media sources. So it takes time, and as I have just mentioned, by next year we should definitely be reaching our 2019-20 numbers and moving ahead. So it seems to be on the right path.
Sorry, just a clarification. When you say that advertisers have moved to other sources, what is the competition for you in these sources? Is it obviously it cannot be? It has to be more hyper local.
Yeah, no. It's not that. It's the fact of the matter is that when you rate a cinema media, it used to come in the 5th or the 6th preference for a media planner and buyer. So technically, when we were out of action during the COVID time, they started to put that money which was available for promotions and media into, digital, into TV, into radio, into outdoor, mall activation. So now we have to go back and start getting all of those advertisers back. The good news is that most of the brands are back, and it's about now when you would see that a bigger traction begins to play out as we move forward into some big blockbuster films releasing over the next 2 quarters.
I understand. What I'm trying to get clarity on is that what is your competition when it comes to this kind of an advertising? Is it like a outdoor digital, or is it like newspapers, or what is it? You will term it as a.
I won't be able to comment on this because the fact of the matter is, if you look at the total advertising pie, cinema advertising is only about 1% of the total pie. So it's very difficult for me to ascertain where that 1% is getting allocated in terms of any alternate media choices. Media planners have different choices available, and we are also a brand building media eventually. So that money could be being spent on digital, on radio, on any media that works best for that product category. So difficult for me to put a finger to say the monies which were coming to me has now gone to outdoor or mall activations. Difficult for me to have an answer around this. Different clients have decided in different strategies, but to get back our share, we are already on it. We've shown a great growth this quarter, and we believe that we are on the right path.
Understood. My second question is on your the 99 rupees subscription plan. I think it is still not extended to the south. Given that our less share we have on the south, is there any reason why the south is excluded, or we don't want to cannibalize the existing revenues? What is the thought process behind this?
So we've all said in media that, we've opened Passport for a big trial program. We are wanting to enroll only 20,000 Passport users in the first phase. We want to close the subscription after that and study the consumption pattern. Down south, the consumption is anyway very high. And this program is largely to propel more consumption, a market which is already fairly fertile and also has price restrictions. We felt that in the first phase, we needed a better clarity on how it changes consumer consumption pattern. So in the next phase, after we've studied the consumer a little more closely and deeply, we may come out with a product for down south as well in phase 2.
Okay, all right. Thanks for the clarification. All the best.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Ankur Periwal from Axis Capital. Please go ahead, sir.
Sure. Yeah, thank you for the opportunity. First, on the synergy benefits overall, your the presentation does highlight benefits coming from F&B as well as F&B box office as well as overall cost synergies. Just trying to understand, is the ATP improvement because of price disparity, and now everything is in sync in terms of pricing across INOX as well as PVR theaters? And secondly, on the F&B side, where are we in terms of updating the menu as well as veg, non-veg options, etc. Across the INOX screens?
So, Ankur, where answering your first question first, where ATP is concerned, yes, you've seen a significant growth in ATP, and that's because of a regular inflation increase as well as the contribution of the entire synergy which has taken place across the two companies. So that's one. Where F&B is concerned, yes, we have changed a lot of menu. Both companies have incorporated the best of menu of either, and whether it was the erstwhile PVR or the erstwhile INOX menus have been now are available in most of the cinema halls across the country. So a lot of work and synergy has been done, as you see from the slide also, whether it's ATP, which has gone up by about 13% year on year, which normally due to inflation used to be only 3.5 to 4.5, as well as F&B SPH has again witnessed a 13% growth, which used to be in the range of 7.5 to 8.5%. So whether it's the menu tweaking, menu mix, all that has contributed to SPH. And the ATP is concerned, yes, proper programming, If there are more cinemas in a cluster, they've been treated as one, so that a patron, whenever he comes, he watches a movie in a gap of 10 to 15 minutes. So this is what the result of synergy has been over the last 6 months.
Sure. So just to clarify, so slide number 19, wherein we are highlighting the ATP growth, organic growth, as well as the implied synergy-led growth. Will be fair to say that on a pro forma number, there will be a 20 rupee higher ATP on an average on an annual basis henceforth as a base case?
Yeah. So, Ankur, the way to look at it is, this year, like we had guided, we will see much higher ticket pricing growth, as, a lot of this stuff will get rationalized and synchronized between both the PVR and Inox properties. And we will see a significantly higher average ticket price growth than the normal averages that we achieve. It may marginally keep on varying quarter on quarter because it's partly also linked to content.
Yeah. Correct.
But we are reasonably confident. Yeah, it will be a decent number. Whether that number will be 20 rupees or 15 rupees is difficult to comment, at this stage, because part of it will be linked to movie by movie performance as well.
Sure, fair enough. And on the SPH side, the full benefits, presumably the launch across, as well as, the acceptance of all the new menu may take maybe a quarter or so. The full benefit, will you expect it, let's say, by the end of this year, which is Q4, or probably we should look at FY25 for that number?
FY25 first quarter, I think we should have largely everything rolled out. It would take about 3 more quarters for the entire synergy in terms of the back-end work and menu, synchronization to happen. To your question on non-veg, already about 74 sites have been rolled out, and a few more are in the pipeline. So the work is happening, and by end of March, that piece will be largely out of the way.
Great. And just continuing, the synergy bit on the advertisement side, while I take your point in terms of the overall macro, etc., but how has been, the industry's response to the negotiated joint sort of, negotiation now on the advertisement as well as, on the convenience fee bit?
It's been tough, and to be very honest, and this year we may not get too much synergies on the advertising front, while there will be growth, but the fact is, in terms of synergy, the major part of the synergy may roll out next year. We will look at a fairly decent growth this year in quarter 3 and 4.
Great, sir. And just last question from my side, on the windowing period among the digital release and the theatricals, for Hindi and regional, where do we stand? Because as I understand, there were certain negotiations again, especially on the regional side, to expand the window.
Kamal, would you like to answer that?
Yes, so the window on Hindi films is 8 weeks. Regional films varies from region to region. Punjabi films, for example, is 8 weeks. Bengali films is 8 weeks. Excuse me. Hollywood films, which are the international segment films, that's 8 weeks. Tamil, Telugu hovers between 4 weeks and 6 weeks. We would not like to comment on any active negotiation, but suffices to say that our endeavor is to sort of standardize windows as far as possible. Our aspiration is to take the windows to minimum 8 weeks. That's our current position on it.
Sure, sir. That's helpful, and that's it from my side. Thank you, and all the best.
Thank you. The next question is from the line of Arjun Khanna from Kotak Mahindra Asset Management. Please go ahead.
Thank you for taking my question, and congratulations on a good set of numbers. Sir, I just wanted to understand the convenience fee in a little bit more detail. For the last few quarters, we are seeing a decline on a per admit level. So last quarter, when this question was asked, we mentioned that now both PVR and Inox are on a revenue base since the deal with Book My Show has come to an end. I was curious why in the second quarter FY24, on a per admit basis, we are down compared to first quarter FY24.
Yeah, I think, Arjun, we answered this question last quarter alone. Our previous contract with online aggregators had a concept of a minimum guaranteed payment irrespective of what the footfalls would be and subject to a revenue share, because there is no minimum guaranteed payment under the existing contract, and online aggregators underperformed in terms of what effective admissions were in cinemas. Our effective realization due to the minimum guarantee commitment in the previous contract was higher than the revenue share commitment, which is not the case under the current contract, and as a result of which that is reflecting on a per admit basis lower.
Sir, but that happened in the previous quarter, since you did allude to that in the previous quarter. So if I look at the second quarter versus first quarter, since the impact is already in the base, we have declined on a quarter-on-quarter level on a per admit basis, while our ATP has moved up from 246 to 276. So I just wanted to understand, is 14.15 the right number, or previous quarter of 15.69 the right number?
So Arjun, our quarter one for the month of May, there was the minimum guarantee under the older contract.
Okay, sure.
April and part of May. And therefore, on a per admit basis, the convenience fee in quarter one was higher.
Sure.
And then we moved to the new contract from May onwards. And that's why, on a per admit basis, you see a drop quarter on quarter.
Sure. So since this quarter is fully on revenue, so this would be the base going forward?
Right.
That's right.
Sure, perfect. Very helpful. Secondly, in terms of the number of screens that we are planning on closing, we have increased from 50 to 60, obviously, given what the multiplexes, where they're situated. Just wanted to understand, how do we look at our growth over this year, next year, and is the real estate availability, etc., largely on track for our growth path that we had earlier articulated?
Yeah, growth path is absolutely intact. We have lots of screens in the pipeline. And this year also, as Mr. Bijli said in his opening statement, that we'll be opening 160 screens. And 68 we've already opened. When we are shutting down only those screens which have come to the end of their life cycle or are not profitable, or the mall is shutting down. So that's the way which we take going forward. And this year we said that 33 we have already closed, and we will in totality close 60 this year. But the answer to your question is that our growth is absolutely intact. And if we go by 160 screens per year, I think that's a very, very aggressive and a nice number for the industry.
Sure. For the next year, so this closure of screens, is it just a one-time event this year, or potentially that could be repeated going forward in the future?
No, it will not be a one-time event. Now we have a fairly mature portfolio every year. We will continue to evaluate, bottom 1 to 2% of our screens, which we believe would have come to an end of the life cycle, and accordingly take decisions to move out. That's the constant part of any retail portfolio. Anyway, screens at the bottom end are not contributing to our profitability and margins. So, closure of these screens should only help positively in our taking our operating margins higher and profitability higher.
Sure. So if you are adding gross between 160 and net, or assuming 1 to 2%, that's around 15 to 30 moving out. So essentially, on a net basis, we are looking at adding 130 to 150. Is that the right way of looking at it?
Yeah. Yes. Absolutely.
Sure. Thank you very much. Wishing you all the best.
Thank you. The next question is from the line of Mayank Dadla from Enam AMC. Please go ahead.
Hello. Hi, thank you for taking the question. Am I audible? Hello.
Yes, sir, you are audible.
Yeah, thank you. Congratulations on a great set of numbers. My question is around the screen openings. So in the earlier calls, we had mentioned that, our vision is to open, expand more towards the south, and around 35 to 40% of the new screen openings will be in the south. Now, pertaining to that, I noticed that, we are fairly concentrated around Karnataka, the new screen openings. So wanted to understand why the skewness towards Karnataka, and what is the strategy as far as other states are concerned in the south?
Well, you've seen that, yes, we opened a few in Karnataka, but does not mean that we will not open in other southern states. It's that those properties were ready to and we opened it. Going forward, you will see more schemes being opened in other parts of the country also. So as we always say that we are a pan-India player, and yes, South is important to us. And this time what you've seen is that we have opened a few properties down South, especially in Karnataka. But the strategy of the company is to be in all possible states, and the guidance which we had given that, yes, South is a preference, it is for all the 4 to 5 states which are over there. And if we get great properties, we will open it. But let me also tell you that in some other states other than Karnataka, our projects are going on, and you'll see opening of our properties very soon.
Sure. Thank you so much. That's all.
Thank you. The next question is from the line of Abhishek Banerjee from ICICI Securities. Please go ahead.
Yeah. Hi. Thanks for the opportunity, and congratulations on a great set of numbers. So just a couple of questions on the outlook first for Q3. Right. So the lineup seemed great. What exactly are you expecting from the movie lineup here, vis-a-vis Q2 results, Q2 numbers? And if you could give us any update on how the screening of matches is going, that would be helpful.
Yeah, see, we'd not like to give any, specific guidance on Q3 or Q4. All we can say is that the content lineup is quite strong. October and November have been slightly slower in terms of movie releases, but December is looking quite packed with almost 2 big films releasing every month. So both Q3 and Q4 are looking quite strong, and they should be decent quarters, but it will be tough to replicate what we managed to get in, Q2, where all the films fired in one quarter, Hindi, regional, and English. That will be a tough act to repeat, but irrespective of that, I think Q3 and Q4 should be good, decent quarters.
Understood. In terms of your ROC, right, now that you have done the merger and you are kind of working in reducing the variability of earnings. So how do you look at ROCE in a steady-state number going forward?
No, you should see ROC inching up strongly in the balance sheet, on a gradual basis. We'll have a full year of, stabilized earnings this year to some extent. And, you will see ROCs at mid-teens level even in the end of the financial year. And, it should get better as we move forward. So clearly, we are very positive. I think as the earnings stabilize and move up with content flow coming in, you will see a significant increase in ROC at a balance sheet level.
Got it. And again, just coming back to the content part, earlier there was this trend of Hindi movies, Bollywood not releasing more than 1 or 2 large budget Hindi movies in a quarter. Now that number seems to be going up significantly. So if Mr. Bijli could comment on whether this is just because of the bunching up of a lot of releases, or is it something that you believe is a sustainable trend going ahead? That would be really helpful.
Kamal, will you take that?
Sure. This is a sustainable trend. The business, the response that producers have seen for bigger films, and without taking away any sheen from the mid-level films, their performance has been also very positive and very strong. But the bigger films have done extraordinary business, and taking a cue from the response that the audience has given to these mainstream, the potboilers, which target every segment of the 4 quadrants, whether it's male, female, above 25, below 25, they have something for everyone. These sort of films, I think, is a sustainable trend because a lot of producers are getting disproportionate return on their investments. actors are sort of expanding on their reach, they're expanding on their brand equity, and which augurs well for them as well in the long term. And therefore, producers, actors naturally would want to do more bigger films. The other trend which would be helpful to exhibition and to film industry at large is that the South Indian films especially, but even non-South Indian regional films are getting pan-India acceptance. So films are getting dubbed in Hindi, and they've started to penetrate territories which till now were sort of focused only on Hindi films or Hollywood films dubbed in Hindi. Regional films are also finding acceptability. So I think this is a sustainable trend. You will see a lot of big films in Hindi. You will continue to see a lot of regional big films being dubbed in Hindi and gaining a lot of success in territories which are on pan-India basis.
Understood. And in terms of your brand portfolio, PVR and Inox continue to be two separate brands as of now. So what would be the vision for each of these brands? Is there a case where you use one of these brands as a comparatively more value effective, more premium, and one as a more value brand, and try to expand the penetration of screens overall? Bring in more footfalls in from the lower consumption categories.
Yeah, so I'd answer that. Both PVR and Inox are very strong brands in the consumer, space. Both the brands have an existence of over 20 years and have a very strong consumer affinity, and consumer visitation behavior. Inox used to get about 70 million footfalls on an annual basis, pre-COVID. PVR used to get 100 million footfalls pre-COVID. With such large footfalls and, consumer base, we've decided that we will continue to run and operate both the brands on an individual basis, while the corporate identity of the company will be PVR and Inox. Both the brands will continue, their journey and will continue to coexist as far as consumers are concerned.
No, so my question was more with regards to, is there a way of using maybe Inox as a more value brand and,
No, we don't think, I've got your question, but, we don't think there is any change we want to do with respect to how both the brands are currently perceived. Both the brands have a certain perception. We want to continue and maintain that perception and not use one brand as a premium brand or one brand as a value brand. That's not the idea.
Understood. Thanks, sir.
Thank you so much. The next question is from the line of Lavanya Totala from UBS. Please go ahead.
Hello. Thank you for the opportunity and congratulations, sir. So most of my questions are answered. Just one thing, when you mentioned ad revenue you expected to recover next year, is it on absolute levels or per screen basis that you expected to reach pre-COVID levels next year?
At absolute level.
Okay. So it will still be lower per screen basis even in FY25 then?
Yes.
Okay. And one thing on the synergy bit, synergies based on the ticket prices for quarter 2, so the 20 rupees which it is showing, it has impact of higher Hollywood share which we have seen in Q2. So most likely that might decline a bit in upcoming quarters, right?
Yes, it could, because ATP is a function of the kind of content we get. Mega blockbusters in Hollywood do drive ATP up. You're right.
And partly, and that point is quite valid. It will obviously, ticket pricing will partly also be impacted by big films. But if you look at, the way we've calculated the synergy, we've not based it on Q2 numbers. Our average ticket pricing growth was 25% in Q2. And average ticket pricing growth in the first quarter was much lower at 3 to 4%. So what we've done is we've calculated over an average of 13% growth, which we've achieved in the first half of the year, which basically we thought is a much more fairer representation because there will be ups and downs, and some quarters will have higher ticket pricing than others due to content. So just wanted to call that out.
Yeah, so I just wanted to mention that because Q2 last year, our ticket price was much lower, like it was somewhere around 225. So even on average basis, we are a bit high for the first half.
That's fair, and what you pointed out is fair. It's quite possible that the second half of the year may have a lower ticket price growth, and so it is not a multiplication formula. It can vary, and it could be lower in the second half of the year. That's possible.
Yeah. So, but F&B, it should be largely sustainable even for the second half. Is that understanding right?
Yes, absolutely. It could be, yes. Yeah.
Okay. Thank you. Thank you so much, sir.
Thank you. The next question is from the line of Favilo from Favilo Funds. Please go ahead.
Congratulations on a great set of numbers, Mr. Bijli, and thank you for the opportunity. My question is on the price elasticity of the tickets. So what I understand is that tickets, even for a blockbuster like Jailer, are priced lower even when there is the demand, as compared to a Jawan in the north. So why is this difference? Is it because of the competition? Or if that is the case, because you are concentrating, the next opening of screens is concentrated in south, right? So if this is the case, how are we going to work on the ATP to increase the ATP down south? And I'll come on to the second question later.
The Jailer was a Tamil film, and in Tamil Nadu, there's a price cap in tickets. So there are a few southern states where there's a cap on tickets, and hence we can't increase it. So the comparison with Jawan and Jailer was not right, because Jawan is all over the country, and in states where there's absolutely free pricing. So that's one answer. And when you said that how will we increase the ticket pricing? Well, for movies which are released in Tamil Nadu or Andhra Pradesh or Telangana, we have to go as per the rates which are already subscribed. But in other states, depending on the demand of the movie, the cost structure of the property, or as per the paying propensity of the people, we can price the tickets accordingly.
Just addition to what Alok said, the price of Jailer in Karnataka was higher than Jawan. That's because Jailer was a bigger film in Karnataka where there is no price restriction. Ours is a very heterogeneous market. Each state, each city has its own dynamics and are governed by the local dynamics. North India, West India, Central India. Jawan was a much bigger title than Jailer, which is the reason Jawan tickets were more expensive as compared to Jailer.
Okay. And on to the second question. And does the overhead spend, that is the food and beverage spend, also vary depending upon the movie? So say, for example, the crowd that might come for a Jawan might spend more versus the crowd that is coming for a Gadar. So does it vary according to the movie too?
Not significantly. It is more region specific. Yes, titles which are, not family titles, or where we see, films which are depressing in nature, which are, more serious films, you can have very selective and a niche audience. So, yes, there is a marginal impact, but largely what we've seen is that it doesn't change for every film. The trend is normally homogeneous, but obviously for each market the trend is different. More and more family films where, the group sizes are larger, people come more often, there is definitely a positive impact on the average of food spending at the cinemas.
Okay, thank you. That was it from us.
Thank you. The next question is from the line of Arun Prasant from Avendus Spark. Please go ahead.
Hi. Thanks for the follow-up questions opportunity. My question is on synergy. So if I look at the PVR Inox combined numbers at the pre-COVID level, we had around 19 to 20% EBITDA margins. And going by the quantified synergy benefits we have shown in this quarter, it looks like our steady-state margin should be at least 200 bits higher than the pre-COVID levels. Is this the right understanding? And this is what we can build in our numbers?
Absolutely. I think this is what we had guided once we realize the full synergy benefits. Clearly, that should have an impact of at least 200 bits on our operating margins.
Right. So that means the current quarter margin, 22%, it is still below our, because this is a very strong quarter. So despite that, we just achieved around our steady-state margins. So in a future scenario where this kind of a blockbuster quarter should result in a much higher margins, right?
This quarter already reflects a very large portion of the merger synergies. But yeah, lot of elements will play out, like advertising revenues still to recover, to the fullest extent. And, if we continue to achieve these kind of level of occupancies, can we do better margins from here? 12 months out, definitely.
Right. Understood. Thanks, Nitin. Thank you very much. All the best once again.
Thank you. The next question is from the line of Apurva Mehta from AM Investments. Please go ahead.
Yes, sir. Congratulations on great set of numbers. Sir, how much would be the synergy benefit in the coming quarters left to pencil out?
We can't, give any quarterly estimates. We've given
maybe on the ballpark basis, okay, we still have like 30% left, or we have 70% we have done with it, 30% still remaining.
Not like to give any guidance here.
Okay. And then the costs, and when we were comparing quarter on quarter, the rentals are up by 12%, personal expenses about 8%, and then other expenses about 16%. So, because rentals are more or less fixed in nature, why there's so much of inflation in such costs? Can you just throw some light?
There are three factors. One, we've added a lot of new screens, new age screens in new shopping centers. So one, there is screen addition. Number two, rentals are subject to annual inflation. Number three, a lot of our rental expense in a lot of properties is linked to revenue share. In quarters where we'll have much higher occupancies, we also end up sharing much higher revenues in form of rentals with the landlords. So all three factors put together is the reason for increase in, revenues, for rental costs.
And for personal and other expense on Q on Q are up by almost 16%. And, so even the...
Same logic, if you calculate, wages are subject to average 7 to 8% annual inflation. And we've added a lot of new screens. If you calculate on a per screen basis, the effective cost increase will be very minimal.
Yeah, but this is again and we have not added any screens barring from Q1 to, Q2. We are more or less at just adding around 15, 17 screens. And the per screen, if you see the everything is going up, other expenses are up, personal expenses are up by 8% Q on quarter. I'm not talking about year on year.
Yeah, so on quarter basis also, see, when you look at the new screen additions that we've done, in terms of new property, on a net basis, you compare per screens. All the old properties that we are shutting down are small, dilapidated screens, whereas the new screens that we are opening are in all modern shopping centers with different quality of staff, more premium screens. One, obviously the cost of running those screens is not the same. Secondly, there is annual wage inflation, minimum wage increases which happen from state to state. Two South Indian states of Tamil Nadu and Karnataka alone have had a 29 to 30% minimum wage inflation this year. So wage inflation definitely takes place. And thirdly, temporary manpower, because a lot of our manpower also goes up. We add manpower when the footfalls are high on cinemas, because we run largely a weekend business, and when the occupancies are at that peak, we have to supplement headcount. So quarter on quarter, we've added headcount this quarter. Our admissions are up from 3.3 crore admissions in Q1 to 4.8 crore admissions, almost 45% over Q1. So we need additional hands to take care of consumers and service them on a weekend. So these three factors put together are the reason for the people cost increase.
And 37 screens is not a less number to open in a quarter with big ticket items like Kanakpura, Bangalore, properties in Rourkela, Patna, Delhi, Harvard. So hence all this adds to the cost.
Okay. And the movie distribution and print charges, which are also gone up substantially, it is because of the blockbuster films coming in, and that's why the thing has gone up, or there is anything else we can do?
That's largely relating to our PVR Pictures business, and it will continue to vary quarter on quarter depending on what films that we are distributing. So it is not linked to our core cinema exhibition business.
Okay, thanks a lot and wish you all the best.
Thank you. The next question is from the line of Yash from Dante Equity. Please go ahead.
Yeah, hi. Congratulations on a good set of numbers. I missed the first 20 minutes of the call, so I'm sorry if this is repetitive. But my question is regarding your debt. Are you giving a guidance on debt for the next 2 years? On where we'll see the debt number in the next 2 years? And also, what's the net debt right now?
Yeah, our net debt at the end of this quarter is about 1,100 crores as compared to 1,430 crores, which was at the beginning of the year. So we've reduced our net debt by 327 crores in the first 6 months. I think I can only give you a directional sense over the next 2 years. Depending upon how the business performs, our endeavor would be to reduce and pare down leverage from even the existing levels. Our current year, endeavor is to get to 1:1 debt to EBITDA. But over a period of next 2 years, we want to fund all our growth from internal accruals, be free cash flow positive, and use the free cash flow to reduce, leverage even from the existing levels.
So with how are your expansion plans basically looking for the next 2 years? And what you're trying to basically tell is that the next phase of expansion will basically come through internal accruals?
That's correct. Even current year, if you look at our presentation, we're adding 160 screens. We've guided that we will, in the first half of the year, we are free cash flow positive after funding all our capex. And the endeavor would be that even for the full year, we are reasonably confident that we will be a free cash flow positive company after funding all our growth from internal accruals.
So just to conclude your answer, would it be safe to conclude that the debt for PVR INOX is peaked out?
Absolutely, it is peaked up. In fact, it is now going down from its peak level.
And could you give me the number for your interest? What rate are you borrowing at on a net level?
Yeah, our average cost of debt is approximately 9%.
And do you see that coming down anytime soon? Because you've become basically cash flow positive, right? And I think that should re-rate you in terms of the debt security market.
Yeah, we pretty much benchmark most of our borrowings to, market. So it will move in line with how the interest rates move from the existing levels. Most of our borrowings are benchmarked to market rates.
Perfect. Thank you for taking my question. I'll come back in queue. Have a good day. Thank you.
Thank you so much. As there are no further questions, I would like to hand the conference over to the management for closing comments. Over to you, sir.
Yeah, thanks everyone for taking out time to join the earnings call. If you have any unanswered questions, please feel free to write to us and we'll be happy to respond. Thank you.
Thank you so much. On behalf of Axis Capital Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your line.